I'm a huge Costco fan. They have kind of an internal barometer. It's like an early recession signal that says as their customers are moving from beef to chicken and then from chicken more to like canned chicken, It is an early recessionary signal. And they've already started to see that shift from beef to chicken. And I can attest to that because when I go out and try to buy a steak at the grocery store, I'm like, I might as well just go out for a fancy dinner. It's $30 for a steak I have to cook myself. The current administration has already started to talk about how can we curtail some of this elevated price impact because consumers are having a hard time putting food on the table. So they need to increase the cattle herds here in the US, which are at like a 75-year low. We need to reduce the import price for beef from places like South America. Anything I've said just now really has nothing to do with earnings, with growth expectations. It doesn't have anything to do with interest rate policy. All of these things are tangible things that we as consumers face and feel on a daily basis. And it starts, of course, with what we pay at the pump. I live in California, filled up my gas tank the other day at $7 a gallon. So everybody that's crying about $4.30 a gallon, I was like, where?
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, I'm speaking with Paisley Nardini. Paisley is the managing director and head of multi-asset solutions at Simplify Asset Management, also co-host of the Building Better Portfolios podcast. Paisley and I talk about a number of different areas of investing. We start talking about that traditional balanced portfolio, the 60-40 portfolio, 60% stocks, 40% bonds. And we started the conversation about why that may not be the best way to think about allocation and what some alternative ways we could think about diversification, think about correlations, think about active investing versus passive investing, and so many other themes. So please enjoy this discussion that goes through allocations, goes through liquid alternatives, hard assets versus equities versus bonds, and hopefully gives you some opportunities to think about how you can improve your own asset allocation decisions. Please enjoy this interview with Paisley Nardini of Simplify Asset Management. Super excited to be speaking today with Paisley Nardini. Paisley's the managing director, head of multi-asset solutions at Simplify Asset Management, also co-host of the Building Better Portfolios podcast. Paisley, great to meet you, and thanks for coming on the show.
Yeah, thanks for having me, David.
We have plenty to talk about. I feel like the markets are eventful. The markets are moving quite a bit. I did check out your LinkedIn profile, and I loved how you described part of, I guess, how you summarize your role, providing insights and expertise to financial advisors and institutional investors to help them navigate what you believe is a fundamentally different investment regime, one defined by higher stock-to-bond correlation, structurally elevated inflation risk, and the breakdown of traditional diversification assumptions. I feel like if we can spend our time knocking down all three of those, that's going to be time very well spent. So I'm excited to chat with you. Can we start at the beginning? I mean, that 60-40 portfolio just continues to come up as a really good idea, and randomly sort of surfaces. I feel like whenever some look back period makes it look pretty good. What's your latest thinking on that sort of traditional balanced portfolio? Is that the future? Is that the past, and why?
Yeah, so I want to start by just like level setting here, setting the stage that I am not your conspiracy theorist. I don't believe that everyone should sell all their bonds. I don't believe that you should sell your equities and go fully into like uncorrelated sources of risk and return. Like there is a time and there is a place for all of the asset classes at any point in time. Like it goes back to Harry Markowitz and like the only free lunch is diversification. And I would say that underpins my investment philosophy is being prudent, but doing so in a way that you can still participate, or as I call prudent participation, because I am a long-term bull when it comes to taking on equity risk in the markets. I think at long term, you get compensated for that. Does that mean there will be bumps along the way? Absolutely. That is the price of entry is volatility. And so if you understand those risks that you're taking, and there will be perhaps prolonged periods where the growth risk in your portfolio or your equity allocation suffers. There's ways to think about diversifying just within that equity risk, though, even like going international. Often we focus on this lost decade in the early 2000s where U.S. equities underperform. Well, guess what? International equities were doing pretty good. So it's not about giving up on an asset class and moving. It's this pendulum swinging, right? And so it's like, how can you stay invested in the markets and do so you can kind of put your head on a pillow at night and have no problem sleeping. So this goes back to the question then of how do you think about the 60-40 portfolio? And I've been in the industry now for about 15 years, which is long enough to at least see some of these themes continue to pop up every couple of years. And one of those is, and the media loves this, the 60-40 is dead, right? It's been so easy to point to that at any point in time where you have a pullback in both stocks and bonds, or a lot of asset managers and investment managers that are coming out with alts will tell you the 60-40 is dead and that's why you need their alts. A bit of that is absolutely true, which is what we can talk about today. Since 2022, stock-bond correlations have been elevated. A lot of that is driven by inflation. And so as we record this in May of 2026, inflation is still front and center. It is still proving to be sticky more so than transitory. However, there are absolutely purposes and reasons why you should still have stocks and bonds, but just simply relying only on stocks and bonds is the issue. And so that's where I like to redirect the narrative of there's been plenty of proof points now since like in the post-COVID era as to why only having stocks and bonds is not going to be your best friend. It's not going to allow you to reach your investment objectives and your long-term goals. It's not going to allow you to protect, because that's very important. Of course, upside is instrumental to build, your capital over time and experience appreciation in your portfolio value. But it's really important not only from protecting your capital, but also the investor psychology of when you have these drawdown periods, can you point to something in your portfolio that has allowed your portfolio to weather the storm and navigate these bouts of volatility? And that's why the backdrop of having diversified sources of risk and return is so important, because bigger picture, we've absolutely seen a shifting of regime. We've seen higher elevated levels of volatility, not only in stocks in the last couple of years, but also in bonds. Much of this has to do with we're in a shifting regime environment for interest rate policy. For the last 30 or 40 years, we've had these structural tailwinds where bond yields have fallen and they've stayed near zero. And so there's really no volatility there. The Fed has been able to maneuver policy as it sees fit. And what we've seen even in today's environment is the Fed is now between a rock and a hard place. You can't cut rates, even though that's what the market's been pricing in for the last couple of years. You can't cut rates with sticky inflation. And employment data hasn't, fallen through the ceiling yet. So there's really no data-driven catalyst for the Fed to cut rates. And so we no longer can rest on monetary policy, or the Fed put, as it's been known. And then you add on top of that what's absolutely in all of our faces today, which is geopolitical risks, rising tensions between various countries and various regions, obviously trade, supply-demand imbalances. And so all of this really underpins what I believe to be a shifting regime for asset allocation and for portfolio construction. So that's a very long-winded response to your question. Is the 60-40 wasn't wrong for the last, 20, 30, 40 years. It was simple and it worked. But if we don't start looking forward, we're only looking in the rearview mirror when it comes to building better portfolios, we're going to be stuck in a different regime and we're probably going to suffer as a result.
There's so many great comments in there, Paisley, that I'd love to tease out through our conversation today. Particularly, you mentioned how I think it's obviously very, very true that at one point that 60-40 balance, right? 60% stocks, 40% bonds made a ton of sense. And I think the correlations have seemed to fluctuate, right? In different regimes and especially recently, right? In 2026, stocks and bonds have generally been moving in lockstep, right? When stocks are working, bonds are working. And then when stocks are selling off, bonds are selling off, rates are going up. How, can you speak a little bit? Because having worked with a lot of advisors, but also a lot of individual investors, that idea of correlations is something I feel like institutional investors kind of think a lot more about. Individuals don't sort of, I guess, appreciate or respect as much. Why is that changing correlations? And what would correlations with some other asset classes we haven't talked about outside of stocks and bonds, why are those correlations so important? And how should that be a part of our process in terms of designing an effective portfolio for tomorrow?
Yeah, so very high level, the importance of having, and this gets a little bit into the math, which I won't do, but I'll just explain.
Yeah.
For anyone that's taken their CFA exam or any of the other kind of like rigorous investment test, you understand from a mathematical perspective, you can have two assets that have similar levels of volatility as measured by their standard deviation. So let's just say, 15% vol and 15% vol. However, if you put those two puzzle pieces together in one portfolio and they move not in lockstep, but in differing directions at certain points in time, think about this. If your equities, let's just say this is your equities and your equities sell off, and this asset also has a 15% standard deviation, but it's moving higher on the day your equity is moving lower, that's going to really dampen the overall volatility of your portfolio. It's just pulling that back to kind of the average. And so if you can really think about very simplistically of two assets, irrespective of their individual volatility profiles having different patterns of movement or co-movement, you can really start to see how that can kind of smooth your overall portfolio volatility of returns. And so from a correlation perspective, why have stock bond correlations moved from over the last 15, 20 years? They've been negative, really actually longer than that, since the early 2000s, since really the post-tech bubble, stock bond correlations have been primarily negative. We've had low to no inflation, which was then exacerbated in the post-GFC era, where we're talking about negative inflation in many of the global developed markets. And so what that does then is it just kind of takes out the volatility of bonds, and bonds start to react to those kind of global growth risks or the recessionary risk that we see in the market. Now that we've been in a higher inflationary environment, and this is typical, at least historically, is when, and the actual level itself is debated, but anywhere above 2.5%, 3% or higher inflation is typically when you see the co-movement of stocks and bonds become more correlated. And that's the environment we've been in. That was the catalyst, which started in the post-COVID, which was driven by, supply-demand imbalances and the shock that resulted in the overall marketplace, that then kind of kicked off extremely high inflation that we saw that kind of peaked in 2021, 2022. We've come down since then, but inflation is still sticky. It's still above whatever this, again, that arbitrary threshold is that's pushing stock bond correlations positive. So unless we get back to, a 2% inflation level, which I predict that to be quite challenging in the next 12 to 24, even 36 months for all the reasons we briefly mentioned, just global tensions, reshoring, supply demand, export import controls. I think there's this structural underpinning that's going to keep inflation somewhat elevated, whether that be 3%, let's just say. But that should result in stock bond correlations continuing to sit in this positive territory. And so provided that's the case, it's going to be difficult from a simplistic portfolio construction standpoint to solely rely on stocks bonds.
Paisley, that was one of the best visual hand gesture representations of correlation that I've seen in some time. That was well done.
I'm a visual person. I'm like one of those, if somebody's explaining something to me and there's no visuals, my eyes cross and glaze over. So I have to
A+. Way better than for me as a chart-based analyst. The visual makes all the difference. Way better than reading an article about diversification and correlation. So A+ there. I like that a lot. So if these old assumptions are no longer serving us well, right? And to your point, the correlations have remained very, very very positively correlated for a while between stocks and bonds. How should we think about diversification, right? What should the new version of that look like? What's the new version of 60/40? What kind of things to think about there?
Yeah, I would say there's two obvious answers to this. One is find something with low to no correlation, which might be the obvious answer to those listening. I think both you and I appreciate strategies that have low and even negative correlation, trend following. If you look at the spectrum of liquid alternatives, and maybe I'll pause here and I'll come back to liquid alts in a second. For the last several years, up until maybe the last year or two, I think there is this belief, whether people truly believed it or were just told by those selling these products, that private equity and private credit were your alternative vehicles. Those are really just levered yet lower headline volatility solutions that are still tethered to equity and credit beta. So yes, they can provide higher return, but I see those as more capital appreciation solutions because they are more levered and they can deliver higher yield or higher growth. We're truly talking here about a diversified source of risk in the portfolio. So not just a levered form of equity and credit beta. So now moving then to liquid alternatives. And if you look at the spectrum of strategies that do provide daily liquidity and are going to provide something that is differentiated and it's untethered to the co-movement of stocks and bonds on a daily basis, trend following has repeatedly shown to be the best bang for your buck. If you think about consistently low and even negative correlations across managers, trend following fits the bill. So there's other form of liquid alts which absolutely have merit and credibility and deserve a place in a portfolio. Global macro, systematic strategies, long short strategies, depending on if they're beta neutral or not is, TBD. But trend following is one of those very easy approaches to introducing that negative correlation. So again, going back to the hand gestures here is like when your 60-40 portfolio is flowing, those might be ebbing and then vice versa. And depending on, because there's a lot of dispersion within liquid alternatives because everybody has their own unique investment process and markets in which they trade in. But for the most part, trend following provides one of those really strong avenues to think about how to find a very simplistic liquid source that is not correlated or offers diversification from stocks bonds. So that's one side of the response. The other side, I would say, is probably a little bit easier for much of the audience to digest, which is more hard assets, tangible assets, things that will stand to benefit from all of these kind of global secular themes that we've touched on, whether it's reshoring, electrification, AI data center build-outs through direct infrastructure, supply-demand imbalances, not to get political, global warming and shifting weather patterns, right? If we have droughts in West Africa, what does that do for the price of cocoa, where 60% of the global cocoa supply is sourced from? That means cocoa prices are going to go up. I think we've all seen it with coffee prices. Something that is even hitting the headlines more recently is needing to address the crazy skyrocketing prices of beef. I mean, Costco, I think, and you're up in the Pacific Northwest, so you'll appreciate this. I'm a huge Costco fan. But they have kind of an internal barometer that's almost like an early recession signal that says as their customers, so those that are going into Costco and shopping, are moving from beef to chicken and then from chicken more to like canned tuna or canned chicken, it is an early recessionary signal. And they've already started to see that shift from beef to chicken. And I can attest to that because when I go out and try to buy a steak at the grocery store, I'm like, I might as well just go out for a fancy dinner. It's $30 for a steak I have to cook myself. All of that being said, the current administration has already started to talk about how can we curtail some of this elevated price impact because consumers are having a hard time putting food on the table. So they need to increase the cattle herds here in the U.S., which are at like a 75-year low. We need to reduce the import price for beef from places like South America. Yeah. All of this to be said is like anything I've said just now really has nothing to do with earnings, with growth expectations. It doesn't have anything to do with interest rate policy. All of these things are tangible things that we as consumers face and feel on a daily basis. And it starts, of course, with what we pay at the pump. I live in California, filled up my gas tank the other day at $7 a gallon. So everybody that's crying about $4.30 a gallon, I was like, where? Like, get me some canisters. We're going to fill up. But again, all of this is way more easily understood. And so going back to your question is like, as an asset allocator and as someone that's managing, whether it's your clients' portfolios or your own money, I have seen firsthand that hard assets, tangible assets are woefully underrepresented in portfolios. I think, we go back 10, 15 years, most advisor portfolios had like a 5% allocation to a diversified commodity, usually passive type benchmark. And then everybody kind of gave up on them because they were so heavily tilted towards oil and gas, which has been extremely deflationary over the last 10 to 20 years. And so now that oil and gas is leading the charge again, that makes up a really large portion, anywhere from a quarter to 33% of some of the major commodity indices. Commodities are now front and center, but it's way more than just a simple energy story. It's in the soft agricultural commodities. It's in metals, right? If we forgot that gold and silver were putting up some historic returns and volatility in the last 6 to 12 months, So there's a really big opportunity because of shifting weather patterns, because of supply demand mismatch, because of import export constraints, that we're going to probably see continued volatility and opportunity as some of these prices dislocate for portfolios to not only be diversified but also experience upside potential.
Yeah, no, I'm glad you mentioned that with commodities. Certainly here in mid-May, we're seeing, I mean, hard assets, things like gold and silver, obviously had remarkably strong 2025. Here in May of 2026, you're seeing wheat, soybeans, corn, all kind of rotating higher. Speaking on behalf of all Seattleites, inflation's fine, but when coffee prices start getting elevated, that's when it really hits home,
It
right? In so
hurts.
many ways. So that hurts every day, multiple times for some
We're
of
not
us.
going to stop drinking the coffee, but we're going to
We'll
complain
still
about it.
consume it though, right? Right. It's still happening. So I love that you mentioned liquid alts or liquid alternatives, right? So as a total rookie question, for those where that phrase makes them try to go Google something and figure out what that means, how would you just sort of describe what is liquid alternative? What does that actually represent? And maybe what are some examples of specific products that one would, put in their portfolio that would give them exposure to that type of instrument?
Yeah, well, first and foremost, the word alternative is a catch-all, right?
Yeah.
Because we have stocks, we have bonds. If you want to do like private equity, private credit as a third category, anything that doesn't fit the bill and it is daily liquid, all of a sudden goes into like this liquid alts catch-all.
The everything else
So
group, right?
exactly. The miscellaneous, it's very heterogeneous in nature, meaning that like even within one category, and let's just go back to systematic trend, which is what we talked a little bit earlier, and just trend following as a really punchy way to diversify. Even within that category, say in Morningstar, there is a ton of dispersion in the markets in which these trend following strategies are competing in, their processes, their time horizons. And so it is a catch-all, which makes it very difficult to decipher and really understand. And this is why there's a growing theme, I think, of kind of these consultant-led discussions to help advisors understand, like, what are they buying, how to think about it, how to allocate to it, where to fund it from. And so some specific examples, again, trend following, also known as managed futures. That's kind of my go-to. That's on one side of the opportunity spectrum. Global macro.
Mhm.
So if you guys are familiar with like some of the more hedge fund type solutions, like Bridgewater's launched some liquid alts with State Street recently. So global macro, hedge-based strategies, so strategies that maybe are not looking to participate in upside, but just really looking to provide something that's unique and uncorrelated. The ability of strategies to be long and short in nature. They'll have varying levels of beta. Where there's been a lot of news lately around kind of equity long short strategies, whether that be for tax advantage purposes. A lot of news on that just related to some of the short squeezing. So the impact that might have as well. But really the ability of strategies to look at oftentimes global markets. So they're agnostic as to which markets sometimes that they look at, meaning they could be looking at equities, they could be looking at interest rates, currencies, commodities, a lot of derivative usage, a lot of like maybe crypto and some of like the more kind of nuanced ways to think about precious metals. And then it's really a unique process whereby a lot of it is more data-driven or quantitative in nature. Not to say that some strategies might have a fundamental underpinning to them where they might have some discretionary trades and such, but a lot of these liquid alts tend to be systematic in nature. And it's really more of just think about like a blank canvas and the ability to invest across regions and markets with a defined objective, which could be capital appreciation. It could be purely diversification from equities and bonds. It could also be what's known as like a tail risk hedge. And so a lot of
Mhm.
times these liquid alts will be constructed so that their payout and when they really show up for you is in worst case kind of black swan type events. Those
Yeah.
tend to be more difficult for clients to hold through a cycle because you're waiting for the worst case outcome. But a lot of the institutional pension allocators have a tail risk or a risk mitigating sleeve within their broader portfolio. And those are the strategies that kind of sit idle for prolonged periods of time. And then like a COVID environment happens, financial crisis environment happens, and that's where that type of allocation shows up. So there's a lot of different ways to think about this. There's a lot of different ways to implement this. And it really comes down to like, what is your core objective? And in my conversations with advisors on a weekly basis, some are saying, like, we just want to start dipping our toes. We want to be a little bit diversified. So maybe commodities are the best way to do that. And
Yeah.
then others are saying, like, we want those black swan, once in a blue moon type payouts of that tail risk hedge. And then others are saying, we just want to be more opportunistic. We want to think about opportunities across asset classes that aren't benchmark tethered. And I say that's probably
Yes.
one of the biggest ways to think about this is oftentimes your equity mandate or your bond mandate is benchmark tethered, whether that be for tracking year or just the constituent universe they can invest in. A lot of times these liquid alts are way more opportunistic and free to kind of allocate and invest where they might see opportunities or avoid risks.
That was an awesome rundown through that space and some of the different opportunities. And really, I mean, it's almost limitless in terms of the different plays that can be made through those sorts of structures. So I appreciate you going through some of those, Paisley. I'm thinking of this hypothetical conversation you're having with an advisor, thinking of dipping their toes. And I think, especially given the uncertainty, the perceived instability in the geopolitical environment, it feels like things are unstable in some ways, even though the market's making new all-time highs. I'm sure some advisors and certainly some of their clients, the challenge of getting away from this 60-40 model is it's different and it's untested for them, and it feels like it's riskier because you're going into this new space that feels very, new and different and uncomfortable. What are some of the tools or ways that you would assess potential risks in some of these products for those that are not as familiar with some of these structures and their implications? How do we appropriately understand the risk versus stocks and bonds that I feel like a lot of investors kind of just generally understand from their own experiences?
This is so important because there is a massive educational gap because a lot of these strategies have historically only been in illiquid wrappers, only available to institutional investors and only available at very high fee levels and performance-based fees, et cetera. With the passage of an SEC rule in 2020, the use of, say, derivatives allowed a lot of these legacy alternative strategies to come to market in ETFs. So now what you're left with as an allocator is a ton of strategies and a ton of noise. And so the educational component to truly understand how to allocate to them, when to allocate to them, and what are the risks.
Yeah.
It's not as simple as these are the 2-3 risks because all of these strategies I just mentioned operate very uniquely and have different underlying risk profiles. I think, and this is not meant to be a cop-out, I actually think the biggest risk is that we as humans that are so familiar with the stock and bond market, we are so tethered to be like, oh, stocks are up, so my portfolio should be up today. And if you hold a strategy that has a low correlation to equities, you might open your account on a daily basis or at the end of the quarter, at the end of the year, and wonder if the stock market was up 15% last year, why was this fund only up 2%? And the psychology of that then is like, get it out of my portfolio, it's a drag. So I think understanding why you have something in your portfolio and when it should perform in a certain way is like absolutely table stakes for allocating to alternatives.
Yeah.
Because we see it, like I had a call with a client this week who was looking at one of our strategies, had held it prior, ended up selling it because it went through a couple of quarters of choppy sideways performance when equities were up 15-20%. Well, that's kind of what you signed up for, So really the educational component. So I would say the risks are not understanding when a certain strategy is going to behave in a certain way. And of course, you can sign up for something, be told it's going to protect you in an equity market sell-off, and maybe it doesn't. And that's when, it's like, okay, is this not performing in line with expectations? But the other risk too is that, and I'll give you another example, a lot of derivative-based strategies will have different payoff profiles that are nonlinear in fashion.
Okay.
And so if you're allocating to strategies that have a high amount of derivatives, and I'll just use an example, we have a lot of strategies at Simplify that are writing options on treasuries. And so when you have an environment like the tariff tantrum in 2025 and equities start to sell off, and let's say, bonds actually do show up for your portfolio, just because you're writing options on treasuries doesn't mean that those are going to behave in the same way that the broader bond market is going to behave. And so a lot of our clients were caught off guard, and it wasn't, we performed exactly as anticipated. But did we communicate that appropriately? Did our clients hear us appropriately? And did they use that in their portfolio appropriately? So it does require, and this is not meant to talk down to anyone, I think even at the institutional level, it requires some hand-holding, but to really understand what are the risks that you're facing, when are these going to behave in the way that you're anticipating, and when they don't behave, why might that be? And so again, if you're thinking about just a simple allocation to a strategy that has low correlation to the S&P and the S&P's up, it's icing on the cake if your diversified strategy is also up. And it's possible it can be because it's just different drivers of risk and return. But we shouldn't be disappointed or then seek to sell something just because it has a couple bad quarters of performance. So I know it's a wishy-washy response, but it's much about psychology of returns and understanding the unique source of risk. And that's the biggest kind of driver of why clients might be disappointed.
Yeah, no, I really appreciate that you're saying that. And I can hear in your voice as you're describing this, I'm sure some firsthand experience of people looking and thinking, what happened. But you're right, those low correlations end up being so powerful. And in terms of portfolio construction, can certainly be, create some meaningful opportunities over time.
I guess one thing I did want to add to that, because I find that even when I speak with very sophisticated allocators who also have their CFA, I mean, these are experienced individuals that have the educational background, they just come down to oftentimes the reason they don't want to allocate to any form of alternative is like, it's not worth having to explain to our clients. And I empathize with that because I too face those conversations. And so the more that, the asset investment managers that are putting together these solutions, packaging them, and then, selling them into the market, the more that we can take on that burden of helping our advisor clients educate their clients to a certain level, right? And oftentimes you don't want to give them all of how the sausage is made because it'll just scare them or overwhelm them. But I do think that as an industry, the educational component is vital. And I think it's something that many firms are not spending enough time doing because these are opaque, they are new, and they operate differently. And so the more we can just be transparent about this and put it all on the table, I think we'll continue to see these allocations grow.
I'm glad you mentioned that education gap. I think with a lot of the financial industry, that's been a challenge that's plagued the industry for many, many decades, and probably more to come. Is that gap between creating, helpful vehicles that should be in the client's best interests, ideally, but then, getting them to understand them enough and appreciate the nuances and understand and appreciate the risks as well. So one final question, Paisley. This has been awesome. I really appreciate this opportunity to dig into some of these themes with you. Tell me a little bit, not to reignite the entire active passive debate, but I started in the industry in 2000, and I feel like that was one of the first big controversial things I heard my clients talking about was active versus passive. And I feel like here in 2026, we're still having this discussion. And at times it's so obvious to some that, one side or the other, it makes so much sense. A lot of these sort of liquid alternatives, there's an active component to that, right? Where you're sort of structuring and making decisions. Can you talk a little bit about what role active management could or should play as part of a diversified portfolio? Because a lot of people, I think, have now been taught by whoever passive is more, is more appropriate, more diversified. Talk to me a little about the active component, what that represents.
Yeah, well, as somebody who spent 3 long, tumultuous years to get their CFA, which is really rooted in fundamental analysis, especially within the equity space, bottom-up security selection. I do think from like an equity perspective, it's just really, there's structural headwinds that are preventing active management to outperform, which we won't get into here. Michael Green, one of my colleagues, has done extensive research on this. He's actually coming out with a book. So if you guys want more insight on active versus passive and why this theme has just persisted for so long, check out Michael Green. He's got a ton of podcast appearances. And I think, David, you mentioned he was in your podcast as well.
We had a great discussion on my podcast. Yeah, for sure.
Okay, cool. Awesome. We should link that here so people can find that easily. In regards to alternatives, you're absolutely right. So I mentioned that many of the alternative strategies that we see in the marketplace are systematic in nature, which tends
Yeah.
to mean that they're driven by a model. Many of these strategies also do have some kind of overarching kind of discretionary portfolio managers that allow them to kind of intervene and make decisions on the model and on some of the positioning at certain times. But my view is that from a portfolio perspective, you can use low cost beta where markets are efficient and be thoughtful about where you're paying for active management, where you're paying
Mm,
for exposure and access to the parts of the market that have historically, like I mentioned, only been in hedge funds with lockups and high fees. Now we're talking about strategies that are 75 basis points, 80 basis points for daily liquid, diversified sources of risk. Like that's mind blowing, even though 80
yeah.
basis points might seem like a very high number next to your passive equities at 3 basis points. And so I think as an allocator, you start to say, like, where is my budget for fee? And what am I paying for? Am I just paying for something that sounds fancy, or am I paying for something that truly differentiates from the low cost beta in my portfolio? Am I paying for risk management? And I think that's the biggest component right there, and why we stress the importance of active is if you're paying for structures within your investment solutions that provide floors to downside protection, that provide very structured outcomes from over this certain period, whether that's a month, a quarter, a year, your expected return is X, your downside is Y. I think that certainty component is why many investors are still willing to pay for active. And I think that's why they've shifted away from just more of a discretionary fundamental stock picking active, which
Hmm.
carries high fees, into like taking that active fee budget, moving it into more structured, systematic approaches for more defined outcomes. And that's typically what you see in the alternative space. And then if you really put a bow on it and think about alternatives, as much as I would love alternative sleeves in a portfolio or the total allocation to be 20-30% of a portfolio, in the advisor community, it's much closer to 10%.
Yeah.
Institutional allocators, sovereign wealth funds, pensions might be closer to that 30%. But from a liquid alts perspective, we're lucky if we see clients, allocate 10% to the space. And so if your fee budget in that 10% sleeve is a little bit higher, but then at, let's just say, the end of first quarter of 2026, for example, do you know how much easier it was for advisors to sit down with their clients when they had alternatives in their portfolio? Hey, your stocks were down, your bonds were down, but this 10% of the portfolio was up, and maybe we paid a little bit more for it. But that's why you're paying us, is to be thoughtful and determining what are our allocations and how can we protect your portfolios from these really kind of one-off periods. So that's how we think about active management. It's more from a risk lens, and it's more
Yeah.
from defining and structuring your outcomes.
I love that word thoughtful that you used a number of times. And I always encourage people a more mindful way of approaching their investment solutions, being thoughtful and intentional about what's included and why. I find a lot of times things are just there for some reason, but not a well-articulated or well-defined one. Great discussion there about active versus passive. We'll definitely include the link to our interview with Michael Green. He had some, let's say he was very open in sharing his opinion on the active versus passive debate, but
Michael Green, opinionated? What?
it was well articulated, and it was a pleasure. We'll also, Paisley, include a link to your Building Better Portfolios podcast, and we wish you much success over there. And the final thing is, thank you so much. Great to meet you. Pleasure to speak with you. Thanks for giving us some time on our show today.
Yeah, appreciate it. Thanks, David.
That was a really fun discussion. And thanks again, Paisley, for joining us from Simplify Asset Management. I love that quote, by the way. The price of entry is volatility. I was taught, and I feel like so often we are surrounded with the message that volatility is risk. And a lot of quantitative methodologies sort of cite volatility as a key risk. And as a matter of fact, we talk about the VIX all the time in our own work, right? The VIX is a measure of volatility. And the higher the VIX, the higher the volatility, the higher the uncertainty, the more dangerous the market most likely is. But I was taught as a technical analyst that volatility is not a risk. Volatility represents opportunity. Unless we have that natural volatility in a data series, in that asset prices, there's not much of a trend to measure, right? The whole idea of following trends is the trend needs to exist, and it exists in a lot of ways because of that volatility, those highs and lows, the peaks and valleys that make a trend over time. So I really appreciated that particular quote, talking about the really the opportunity of volatility, and that's a natural part of taking a bet in our portfolio, right? If we're allocating to some sort of risk asset, volatility is going to be part of that game. So being thoughtful and intentional about that volatility and what it means for our portfolio, I think, is what's most important. Really appreciate the opportunity to ask someone like Paisley about liquid alts or liquid alternatives. If you're an advisor, maybe you've been thinking about your allocation, getting your clients to some alternative assets. And I think that discussion of liquid alts, right? Different products that give access to markets that traditionally were inaccessible to a lot of individual investors, but now, sort of have possibilities. I thought that was really helpful, and really talking through the different types of structures, because it really is a catch-all. There's a big umbrella there. I really appreciate a lot of the different discussions about some of the systematic trend following, CTA type of investing. That's a commodity trading advisor, right? Systematic sort of futures trend following approach. But one that I thought I'm glad that Paisley brought up was sort of the tail risk or black swan products, right? Things that are, giving you an opportunity to bet on some highly unlikely situation, right? That black swan event, something that's probably maybe not going to happen, but if it does happen, you're really going to be thankful you have that part of your portfolio, a small part of your portfolio allocated to that. And I'm glad that was that came up in our conversation. Also, really enjoyed that active versus passive debate there at the end. Paisley mentioned a podcast interview with their colleague Michael Green, who's a portfolio manager and chief strategist at Simplify Asset Management. I'll make sure we include a link to that interview because really, really interesting, thought-provoking discussion about active versus passive and some specific thoughts. I'll let Michael share the main conclusions because he's gone through and crunched a lot of data to try to answer that question over time. But specifically on active management, I think too often, as we sort of discussed a bit, I feel like too often active management gets portrayed in a very negative light and focuses on returns, right? Passive products have these returns at relatively low cost. Why pay more for an active manager who's not going to perform as well? The performance isn't there. The cost is higher. That's it. And I think Paisley's point was it really matters what you're paying for, right? To think about what you're paying for with active management. I think two areas that, specifically came out of the discussion, there are probably others. One was risk management, right? And having an active manager who's, really thinking, being thoughtful and intentional about risks and where those risks might be and adjusting portfolio or adjusting bets based on those risks and the changing risk landscape, I think is an important one. So not just about returns, but also the risks involved in achieving those potential returns. Also, tax advantage portfolios, tax advantage investing is one area where active management certainly can provide some value. So really appreciated that discussion about the active versus management debate. And as always, I love asking guests like Paisley about the particular market environment, right? We're in a situation where inflation seems less transitory and more of a permanent fixture in the modern economy. We have events in the Middle East creating all sorts of instability. And I think, thinking about asset allocation seems more important than ever, right? And just thinking about what those bets are. And going back to the beginning of our conversation, the correlation between stocks and bonds. If you're diversifying, quote unquote, into two different asset classes that are kind of doing the same thing, that's not much diversification. So I really appreciated this discussion. Thinking about that 5, 10, 20, 30%, whatever portion of your portfolio or your client's portfolios that you think going into alternative assets, what we described as liquid alts, also hard assets like gold, silver, things like real estate, how those can really provide some better diversification because of the different correlations that oftentimes are really the game. So thanks again to Paisley Nardini joining us from Simplify Asset Management. By the way, Paisley is also the co-host of the Building Better Portfolios podcast. We'll make sure we include a link to that podcast as well. That'll do it for today's episode. By the way, if you want to learn more about trend following, that is really essential to how we think about the market environment through systematic analysis using technical analysis tools and behavioral finance concepts. If you want to learn more about how you can be a better trend follower and hopefully make some better allocation decisions in your own portfolios, or for your clients' portfolios if you're an advisor. Our Market Misbehavior premium memberships could be a great opportunity for you to upgrade your own investment strategies here in 2026 and beyond. 3 great benefits to the premium membership. First off, we'll teach you all about technical analysis and behavioral finance with our virtual courses. Number 2, we will keep you informed and educated and all up to date on the changing investing landscape with our weekly flight plan, our main investing report, also our monthly chart review where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, we will answer your questions and keep you accountable and hopefully a little entertained with our member community. You'll have full and immediate access to a community of like-minded investors trying to navigate these markets, trying to learn about some of these tools and asking great questions along the way. All of that is part of our Market Misbehavior Premium membership. You can learn more by going to marketmisbehavior.com/premium. Hope to see some of you as premium members real soon. For Market Misbehavior, my name is Dave Keller. Thanks so much for joining me here today on the podcast. I'll look forward to another episode here very soon. In the meantime, remember, it's always a good time to own good charts. Take care, folks.